Braintree powers 25 billion transactions a year for companies like Uber, Airbnb, and GitHub. But if you're trying to use it to run a business in India, the door is tightly shut. Braintree's supported merchant regions cover the US, the UK, Australia, and parts of Europe. India is not on that list. You cannot run a direct merchant account on Braintree for a domestic Indian incorporated business. To get around this, founders incorporate a U.S. Delaware C Corp, open a U.S. bank account like Mercury or Brex, and sign up as a U.S. entity purely to process payments. Trying to access a top-tier global gateway this way puts you in a difficult position. You are forced to choose between keeping your daily operations simple and getting access to modern global payment features. This workaround, setting up a foreign shell company and a foreign bank account just to accept credit cards, creates a permanent structural drag on your company. Running a Delaware C Corp means managing 2 tax jurisdictions and filing U.S. corporate tax returns like Form 1120. You have to ask yourself if that legal overhead is a necessary investment for your current scale or a trap that will drain your focus. This chart compares setup effort versus actual cost. The Braintree offshore setup sits sharply up here in the high complexity and high cost quadrant. Platforms built natively for cross-border Indian payments, like Playto Pay, sit entirely on the opposite end, low complexity and low cost. Operating in the high-friction quadrant before your business actually needs to will erode your cash reserves and pull your attention away from building your product. Braintree advertises a standard U.S. rate of 2.59% plus 49 cents per transaction. But if you are an Indian founder using a U.S. entity to accept payments globally, you will almost never pay that base rate. Track a $5,000 payment. Start with the base rate. Outside cards add 1% cross-border and 1% international fees. Currency markups at 3%. Wiring to India adds fees and bank FX. You lose 10%. A seemingly low base rate is irrelevant if the actual cost of cross-border processing relies on stacking 4 separate penalty fees on top of it. Those per-transaction fees eat your margins, but they aren't the only expense. To keep a U.S. corporate structure alive, you pay a heavy recurring premium before you even make a sale. Every year, you pay registered agents, Wyoming or Delaware franchise taxes, and thousands for a U.S. CPA to file your compliance documents. That adds up to $1,500 to $4,500 in pure overhead. Beyond hard costs, you face the daily friction of reconciling distinct bank accounts across separate tax jurisdictions while navigating complex intercompany transfer pricing rules. Your revenue gets trapped in the U.S. bank account. Getting it to India requires active, manual wire transfers that slow down your working capital. This setup acts as a rigid, enterprise-grade compliance tax, pulling capital and time away from early-stage businesses that cannot afford to lose either. You give up the vanity of a U.S. corporate entity, but gain immediate liquidity, eliminating all the legal and accounting bloat that comes with it. There are older domestic platforms like Razorpay or Cashfree that also let you skip the U.S. setup to accept international cards. However, these domestic-first tools charge a base processing fee and then apply an opaque foreign exchange markup of 1 to 2% on top, pushing your total cost to around 5%. Foreign exchange markups fluctuate, making it difficult to predict your exact margins on international sales. Securing a predictable, transparent processing rate protects your bottom line far better than dealing with hidden local currency conversions. Despite the high friction, there are specific situations where taking on the Braintree offshore setup is absolutely the right operational move. If your company is processing over $500,000 in annual international revenue, or you are actively raising funding from U.S. venture capital firms, the math changes. At that scale, the structure aligns with your goals. U.S. VC funds heavily prefer investing in Delaware C Corps, making offshore incorporation a prerequisite. Likewise, large U.S. enterprise buyers frequently require their vendors to be domiciled in the U.S. In these cases, the Delaware entity is mandatory, and the Braintree merchant account is just a convenient byproduct. The heavy compliance burden makes sense only when it is a direct requirement to unlock enterprise-level capital and customer contracts. But if you are a freelancer, an agency, or a SaaS founder currently operating below that $500,000 threshold, you do not need that structure. This chart maps your decision. Are you raising U.S. venture capital or landing enterprise contracts? If yes, and your revenue exceeds $500,000, the Stripe or Braintree offshore setup is logical. If no, protect your margins. Set up directly with Playto Pay. Bypassing the U.S. entity saves you hundreds of dollars on a standard $5,000 transaction, and it wipes out thousands of dollars in annual accounting overhead. Match your infrastructure to the reality of your current scale. Keep your overhead low and your cash flow high until your growth strictly demands the structural complexity of an offshore setup.